You know, in the insurance world, the biggest threats we face often aren't the storms or the accidents we underwrite. Instead, they're the invisible financial webs we weave. If you think back to the major financial shocks of the past, the true damage wasn't caused by standard insurance claims, but by complex, highly opaque capital market activities. So let's dive into this explainer. Today, we're covering systemic risk metrics, focusing specifically on how to report your total exposure to centrally and non-centrally cleared derivative instruments, the fair value of your securities lending collateral assets, and your qualitative approach to managing capital and liquidity risks. If you're operating an insurance entity today, you already know the regulatory landscape is shifting right beneath your feet. Regulators are carefully scrutinizing non-traditional activities that could potentially pose or amplify existential threats to the broader global financial system. So we're going to break down exactly what you need to disclose to meet these rigorous SASB standards. To make this compliance roadmap as clear as possible, we've broken it down into 5 key areas. First, the threat of systemic risk. Second, reporting derivative exposures. Third, securities lending collateral assets. Fourth, managing capital and liquidity. And finally, the big picture. Before we get into the metrics themselves, we need to talk about deadlines. These SASB standards, which are now under the stewardship of the International Sustainability Standards Board, or ISSB, carry a very firm effective date. Version 2025-12 of the standard is effective for all entities for annual reporting periods beginning on or after January 1, 2027. Now, I know 2027 might sound like it's in a distant future, but in the world of financial infrastructure, that's practically tomorrow. Rewiring your enterprise data systems to capture this level of granular risk exposure is a massive undertaking. Earlier application is permitted, but 2027 is the hard line, which means the time to audit and upgrade your reporting infrastructure is literally right now. Okay, let's start with Section 1, the threat of systemic risk and the macro threat we're dealing with. Regulators heavily target non-traditional activities, things like writing credit default swaps or executing large-scale securities lending programs. Why? Well, because they're incredibly vulnerable to sudden market developments, and they act as massive amplifiers of systemic risk. Let's break down what that actually looks like in practice. If an entity engages heavily in maturity transformation, which is basically using short-term borrowing to fund long-term illiquid investments, they can trigger a devastating liquidity crisis if the markets freeze and those short-term lenders suddenly demand their money back. Then you have leverage, which multiplies both your gains and your devastating losses. And finally, the imperfect transfer of credit risk. It's kind of like buying fire insurance on a skyscraper from someone who doesn't actually have the capital to pay out if the building burns down. The sheer size and complexity of insurance entities mean that participating in these activities could get you designated as a systemically important financial institution. And trust me, that designation brings a whole new world of stricter regulatory standards and inescapable oversight. That brings us to Section 2, reporting derivative exposures. This is our first quantitative pillar. The central insight you need to take away here is how specifically you must compartmentalize your derivative data. Under SASB metric FNN55A.1, you've got to disclose your total derivative exposure across 3 exact categories, completely regardless of their maturity dates. First up, you need your total exposure to non-centrally cleared derivatives. These are your bilateral, over-the-counter agreements where you're directly exposed to a counterparty's default risk. Second, you have to report the total fair value of acceptable collateral you've posted with a central clearinghouse. And third, your total exposure to centrally cleared derivatives, where the clearinghouse is acting as the middleman to mutualize the risk. By breaking it down this way, regulators get a highly categorized, comprehensive snapshot of your true derivative footprint. So, what's the crucial point to remember here? It's getting the boundaries absolutely right. You have to explicitly exclude exchange-traded derivatives from your non-centrally and centrally cleared totals. When you're calculating exposure to non-centrally cleared derivatives, include the OTC derivatives across all counterparties, regardless of their underlying credit quality. But, and this is a big but, you must explicitly exclude those exact same OTC derivatives from your centrally cleared exposure calculations. The goal here is precision. Regulators are laser-focused on making sure you aren't double counting across your buckets, which would heavily distort your risk profile. Your reporting has to perfectly align with these technical boundaries. Let's move on to Section 3, securities lending collateral assets. Your metric here, which is labeled FN-N-50A.2, must represent 100% of the absolute total fair value of your reinvested collateral assets. You know, it might actually surprise you to learn just how much hidden risk lives entirely off balance sheet in the modern financial sector. That is exactly why this metric demands such total transparency. When you engage in securities lending, you lend out an asset and receive collateral, which is often cash. You then reinvest that cash collateral to earn a yield. Well, that reinvestment creates an entirely new layer of risk. Crucially, your disclosure has to account for these reinvested assets, whether they're sitting on your balance sheet or not. And again, entirely regardless of their maturity date. The whole point is to illuminate the shadow risks generated from your securities lending programs.
The standard is incredibly specific about the scope of assets you need to track here. You aren't just looking at a flat list, you're categorizing things across the entire liquidity spectrum. You've got to track highly tangible, relatively illiquid assets, like physical real estate and mortgage loans, right alongside your standard bonds, equities, and immediate cash. But it doesn't stop there. It explicitly includes highly complex instruments derived from that reinvestment. We're talking options, caps, floors, collars, swaps, future contracts, and forwards. Why do regulators want all these specific buckets? Because physical real estate takes months to liquidate in a crisis, while cash is instantaneous. They need to see your exact liquidity timeline.
For our third pillar, we transition from the raw numbers to the strategy behind them. Section 4, managing capital and liquidity. This is our qualitative narrative.
As we all know, numbers only tell regulators the potential size of the explosive. The narrative tells them if you actually know how to diffuse it. This is the fundamental question your disclosure has to answer. You need to prove that your entity can survive sudden, catastrophic market distress. Metric FNIN 55A.3 demands a really thorough description of your approach to risk. It's not enough to just hold the assets. You have to explain the actual mechanics of how you govern them. And this narrative must encompass all parts of your insurance group. That includes the dark corners, any unregulated non-insurance entities or partly owned subsidiaries that engage in these activities. Risk often hides where the spotlight rarely shines, and this standard forces you to illuminate your entire ecosystem.
Creating this narrative requires some exceptional depth. You need to detail your risk management policies, both the ones adopted for strict regulatory compliance and the ones you've adopted voluntarily as best practice. But regulators really want to know what happens when things actually go wrong. You must explain your stress testing and contingency planning for severe market situations. Describe the exact responsiveness of your enterprise risk management framework to both internal and external shocks. For instance, how do you handle a sudden collateral call on a massive derivative contract? Your narrative needs to explicitly outline your defense mechanisms against specific liquidity drains, like brutal mark-to-market changes or having collateral locked up in illiquid assets. Let's bring all of these quantitative and qualitative pillars together now. Section 5, the big picture, focusing on the overall impact. Ultimately, this is what the entire SASB framework is driving towards. Yes, regulatory compliance is incredibly complex and costly, and failing to meet these thresholds could lead to substantial penalties. But honestly, providing clear, highly structured disclosures acts as a massive competitive advantage. It builds immense market trust. When you can comprehensively detail your systemic risk exposure and your management strategies, it proves to investors, to regulators, and to the public that you are an anchor in the storm. It proves your entity has the ironclad governance in place to manage complex capital markets activities, ensuring you won't just act as a risk amplifier during the next financial crisis. As we wrap up this explainer, I want to leave you to reflect on your own organization. We've seen that capturing the exact 100% fair value of reinvested collateral, isolating your non-centrally cleared derivative exposures, and documenting the rapid responsiveness of your ERM framework requires a highly sophisticated data architecture. The 2027 deadline may seem like it's a ways off, but rewiring a massive organization to capture and report these metrics is a multi-year marathon. So, when the next financial shockwaves hit, will your data prove that you're a pillar of stability, or will it expose you as a systemic risk? Is your infrastructure truly ready?